Hello, and welcome to our latest video chat in the MoneyShow Expert Interview Series. I'm Mike Larson, Editor-in-Chief at MoneyShow, and today I have the pleasure of speaking with Randall Ely. Randall is an experienced investment professional who founded the Edgar Lomax company in 1986. The firm is dedicated to serving institutional and high net worth clients through its separate accounts product and retail clients through its mutual fund, the Edgar Lomax Value Fund. The firm managed approximately $1.7 billion in assets as of December 2022. Mr. Ely is a two-time winner of the Wall Street Journal's Dartboard Stock Picking Contest and has made repeat appearances on CNN, the Nightly Business Report, and CNBC. Randall, thank you so much for joining me today.
Thank you for having me. It's a pleasure.
Randall, let's start, I guess, by talking about your specialty and your firm's specialty, which is, of course, value investing. A few years back, all investors wanted was growth, and more growth. But as the economic and interest rate climate has shifted, value has clearly come back into style. So I guess I'd like to ask what your thoughts are on that shift, whether you think it's going to last and why.
I think it should last a long time because value's actually been out of favor for a lengthy period, going just about back to the Great Recession, 2008. I mean, there have been 2 or 3 years that we saw, we saw it come to life and thought there was going to be, a full cycle of 2 or 3 years, but it hasn't happened yet. Even if you notice in January of this year, growth has come back with a vengeance.
Yep.
And I would go so far as to say not just growth, but also risk on assets. Investors seem less worried about financial strength, long-term dividend records, earnings records. And this is the kind of environment that tends to push some people away from value, but to us, it's just a great accumulation period.
Got it. So for people who may not understand sort of, what some of the forces are that drive investors at sometimes to favor growth and at sometimes to favor value, what is it that has been behind that sort of resurgence with maybe January accepted over the last year or so?
I think people are simply expecting the economic environment to go back to the mid-2020 period. It's very easy for investors like the generals who always fight the last war, the long thing. It's very easy for most investors to, in remembering the past, to remember the very recent past. So the moment we started receiving signals from the Fed that perhaps disinflation was now beginning, see, in people's minds, that was a signal that the Federal Reserve is not worried about inflation anymore. And they don't just think that interest rate rises will slow. What they think is suddenly we will get interest rate cuts. And when they think cuts, they're not thinking about a few incremental quarter basis points cuts. They're thinking of 1%, 1.5%, 1%, at a time, plus more quantitative easing. In fact, I think most investors are not even noticing that this quantitative tightening is going on in the background and supposedly is going to go on for some time.
Well, it was interesting. I saw one of the interviews you did on CNBC a few months ago, and you talked about the benefits at that time of owning some of the recession-resistant names, utilities, the likelihood that inflation may have peaked, and so on. I'm kind of curious, again, I think that was back in October. What have you seen since then? And is that still sort of your base case, or how do you see things evolving over the next couple of quarters?
Yes, at Edgar Lomax, we feel very much the same as we did in October. I don't think the economic environment has changed that much. Investors tend to project ahead. Mm-hmm. And as data comes out and they find that they will very often think that one projection was wrong, wherein perhaps the numbers they were looking for were delayed. And I think that's what we're going through right now. So many investors feared, and I think rightly so, during the fall, that earnings growth would slow significantly, and perhaps we would see earnings decline. And I think we are seeing declines in S&P 500 companies' earnings so far this quarter, but the declines are not yet as steep as many investors were expecting. So in their minds, everything will go back to what they see as normal, which is a rapid earnings growth in the second and third quarter. And so I wouldn't be surprised if we don't see rather volatile markets. The markets are always volatile, but I mean a bit more volatile than usual, in that we have the sharp up during the first quarter of 2023, and perhaps as we go through the next 2 or 3 quarters, we may see ups and downs a bit more frequently than normal.
Yeah. Okay. When I look at some of your recently reported top holdings, it's names, and I know obviously these can change, but it's names like Dow, Walgreens Boots, Chevron, and so on. FedEx, I believe, was one of them. What do those kinds of companies have in common, and what is it that attracts you to those kinds of names in this environment?
Right. The big thing, like, and if you notice, they're all dividend payers. So these are older companies in fields that there's no issue about whether consumers need or want their products. This is healthcare. It is even some of the basic financials, the more solid commercial banks, the industrials, and as you mentioned earlier, utilities. So in an environment in which earnings may decline a bit more sharply than is normal, which we think can happen over the course of the remainder of this year, those stocks will come in very well. We are buying them on a low price to earnings basis using trailing 12 months, by the way. We're not projecting, except to project that what they have earned, they can keep earning. So we think that that making money in investments is a bit less risky over the next year or two by having less disappointments than might be the case if we look for and are willing to pay for rapidly growing earnings, and then that doesn't happen.
Understood. In the remaining moments that we have, I mean, one of the things you're going to be participating in at the summit is a bargain hunting and stocks panel that we're putting together. And I'm kind of curious, given what's happened, given the lousy 2022 environment that we had, and maybe we're starting to come out of, what are your views about market valuations here? Is this a time for investors to be aggressively bargain hunting? Is it a time to maybe just dip your toe in the water, but keep some capital in reserve? I'm sort of curious where you come down on that.
Yes. Well, first, we are believers that long-term investors should always be in stocks. We rarely believe in selling large portions of a portfolio, but we also think it should always be done carefully. And the higher markets have risen, the more careful people should be. So any investor coming into a large block of funds, we think would be well advised to split the total amount up into segments, investing over some period, like over the next three to 4 years. And that way, no matter what happens to the market, even a great decline, they use it as an opportunity because they're buying at lower prices, therefore will make higher returns. The bear market we had in 2022 helped valuation some, but an 18 to 18.5% decline of the S&P 500 is not that much. In other words, it's not an enormous bear market in terms of the rises we had seen over the 2 to 3 year period before. So there could be more downside. If there's not, we will much prefer that disappointments are that the markets went up more strongly than we were than the opposite. So we think our long-term investing plan is going to be right for both cases, but we think investors would be wise to be cautious here.
Okay. Well, Randall, I really do appreciate your insights here, and I'm sure all of our viewers do as well. Thank you for watching. I hope you did enjoy this interview, and if you did, you're going to love seeing our experts in person at the Global Portfolio Strategy Summit that is starting very soon in New York. You're going to have the chance to ask questions of experts like Randall, learn about their unique investment approach, and basically interact with some of the smartest people in finance. So click the link in the video description below, and you'll find out more details about the summit. Randall, thank you very much for your time.
Thank you for having me.